everybody. Today we are going through our newest quarterly update, Q4 2023. Just like the lag cadence of some of our last documents, we've gone over some changes in portfolio analysis, leading indicators both domestically in the US and globally. And we kind of go also through, at the end, some annuity and structured sales updates. But let's kind of get into the broad-based sectors that we really discuss. Tim, a big theme that we've talked about both on the podcasts and webinars and in this document is higher for longer. Let's talk about what that means in 2024.
Yeah, I mean, coming into 2023, we were really part of the consensus that kind of made the assumption that as all of the fiscal stimulus started to wear off, monetary policy would really start to kick in, and that we would probably have a recession by the end of the year. But as the year wore on, it became very clear that there were some things that were different about this cycle that were really creating more demand. And I think the two big ones are just the size of the fiscal stimulus, right? The amount of wealth that was created. Median accounts are still quite a bit higher than they were than before the pandemic. And then also the fact that then it takes a long time for all of the IRA and the CHIPS Act funding to actually be put to use. So states are sitting on all of this cash. And remember the whole thing, there's no shovel-ready projects. There's still no shovel-ready projects. So it takes a long time. So there's been a much bigger fiscal tail, not surprisingly, right? You print $7 or $8 trillion, it's going to hang around for a while. And the other thing is just wage growth. And the way wage growth begets demand, and the way wage growth keeps demand high, and that has been a real tailwind for the economy. So even though the money supply has come down, the velocity of money has gone up. And then the other thing where the market really got lucky, in two ways. AI became this reality that everybody got very, very excited about. So regardless of how much tangible change there has been to the economy as a result of AI, it was a multiple driver that everybody could be excited about as something that would drive productivity in the future. And our economy very much needs something to drive productivity. And then the other thing where we just got lucky is that oil prices came in quite a bit, right? The production in the Permian was higher than expected. Production from Venezuela and Russia and Iran, the rogue states, where we didn't really enforce any of these sanctions. So you had a supply situation in oil that was really beneficial and allowed the dynamic, which has been so bullish, for growth to come, for inflation to fall faster than growth.
We talk about the QRA in this document. Obviously, we're kind of the opinion in this document that we're going to see closer to 3 Fed cuts rather than 7.
Right.
But what's kind of underrepresented in the conversation writ large is what's coming out of the cabinet, what's coming out of the Secretary of Treasury.
Yeah.
So, people were shocked at the moves in terms of what duration we were doing and the most recent QRA.
Yeah.
How is that going to play out in the rest of the year?
Yeah, we wrote about this in this document. We talked about and we referenced a note that we wrote back on November 1st where we said, look, we're going to get a rally here. We're going to get a relief rally here because you're going to see the 10-year come in because there's so little issuance of duration, whereas only normally 20% of issuance from the Treasury is in bills, 6-month, 3-month type bills. This time it's been over 70% in the most recent QRA. Now we're going to get a QRA again here in a couple days here at the end of January. And my expectation is that the Treasury Secretary, which I don't believe the Fed is particularly political, but obviously the Treasury is, and they've got an ability to keep that issuance at the front end. That keeps supply down and should keep the long end down. And that matters for people. That matters for housing. That matters for car buyers. So the Treasury kind of suppressing the long end of the curve, keeping rates down on the long end, that really matters. And what you see is a situation now in late January where financial conditions on various measures, people look at the Goldman Sachs Financial Conditions Index, is looser. Financial conditions are looser than when the Fed embarked on their tightening cycle. So we probably shouldn't be so surprised that the economy and demand has held up as well as it has. Plus all the gains from stock markets, all the wealth that has been created in housing with all the stimulus and the newly created wealth.
We mentioned, despite the fact that we've seen broad-based earnings revisions, we haven't seen, a lot of these multiple expansions, really what we've been looking at.
Right.
I know when we talk about our 10 variant views,
Yep.
you think that the S&P is going to trade sideways or a little bit negative towards December to December, possibly.
Yeah, we've already had so much multiple expansion, right? Not necessarily in the IWMs and small caps, and because you haven't. But in large cap tech, which has driven the S&P, more than half of the performance of the S&P, you've had huge multiple expansion. So I learned this business by thinking about, is company ABC going to beat earnings? Are they going to have earnings higher than consensus expectations or lower? And we're in an environment where earnings revisions keep coming down. Earnings revisions coming into fourth quarter earnings a few months ago were at 8% growth. They got revised all the way down to 0% growth, and now 2024 continues to be revised lower. You look at this massive delta in performance between the S&P and the IWMs. IWM has had really meaningful negative revisions, and for the IWM, it's mattered. The Russell, the small caps and mid caps are still 20% off of their all-time highs, while we today have the S&P making new highs. And while the revisions have not been as negative in the S&P, they've still been negative. So it's just hard for me to articulate an argument as to why we should have more multiple expansion than we've already had, when I don't believe that inflation is just simply going to melt away.
What's kind of the bull's view of energy stocks right now? Within this document, and I'm highlighting this copper in particular, copper's kind of traded sideways throughout the year. We call it Dr. Copper because it's, prevalence in construction, manufacturing equipment, and just overall actually consumer staples. What do we think broadly based, what happens to the demand of copper and then, oil and everything else?
Yeah. Well, let's start with energy. And energy, I've been very bullish on energy. I've been long and wrong on energy over the last 6 months. But I feel like, and I understand that energy is basically impossible to predict on a short-term basis. But I have a very long-term bullish view that you are just going to simply have demand outstrip supply. We've talked a lot about in our presentations how supply in the developed world is going to be limited by the lack of spending on growing resources. There's been a shareholder revolt, as Steve Eisman says, and we spend more money on dividends and buybacks in the energy patch than we do in developing resources, where on the demand side, the global emerging middle class will grow inexorably. And as it does, you get people who go from consuming basically no oil to having a car, having a moped, consuming meat from outside of their village, to having an air conditioner. And all of a sudden, that creates much more meaningful demand. And you're talking about billions and billions of people. So while we in US and Europeans will consume slightly less oil over the next 5 and 10 years, the rest of the world is going to consume the cheapest form of energy that they can get. Now, what is partly offsetting that is electrification, right? We're going to electrify the planet, right? Everybody's going to be driving electric cars. Well, if that's the case, we are going to need multiples more copper than we have now. Now, why have copper prices gone up meaningfully? Because as you note in the document, China's demand with residential real estate has fallen off a cliff. So you have a ephemeral drop to copper demand, but you have a structural, underlying demand factor, which is electrification. So I really feel like there's a great opportunity with copper, because when you look at the top copper producers, they are not growing capex. They are not growing production. And yet the world needs far more copper. That to me is a really good setup, and the weakness in China creates that near-term demand vacuum that keeps the metal from being badly undersupplied. But longer term, there is going to be a supply problem in copper.
Yeah, let's kind of go into the global indicators now, the global take. You mentioned China's really come off a boil even once they got rid of the one COVID policy. Real estate's been a big issue. European picture's been a little bit more mixed, right? I mean, it seems like Greece and some of the more southern countries of Europe had a great year. Greek stock market was up 40%, but the big economies, the UK, the Germany, everything else was pretty sluggish.
Germany is all of a sudden the sick man of Europe, right? I don't ever remember that being the case. But Germany is really slow. Germany has a lot of the same problems that the United States has, but worse. They have a worse demographic issue. Their aging demographic is really problematic, and they don't have the kind of consumer demand. They haven't had the kind of stimulus that we had in the United States, and that's the biggest difference. We created a lot more debt than they did in the EU. The Germans don't. That's just not in their ethos, right? To have huge deficit spending. So that is a big difference. So Germany is really soft. The UK is actually holding up kind of okay, but they're holding up with 5% and 6% type inflation while they're only enjoying maybe 1% type growth. So when I talk about mild stagflation in Europe, that's what I'm talking about. Minimal growth, maybe not a recession, but you still have really problematic inflation. And one of the reasons is that you still have really meaningful wage growth, whether you're talking about Europe or the UK, despite there being a lack of economic growth. And then on China, I just think China is going to have a hard time stimulating their way out of out of two things. One is the balance sheet recession, right? We're talking about the individual balance sheets of the Chinese people who tend to be savers, right? Just that's their ethos. Yeah. They are going to be savers. They are not going to just spend their way out of the slowdown like Americans. And then the other issue is they haven't taken the pain yet on residential real estate. It was this morning that Evergrande stock was down 20%. There's a whole lot of zombie real estate developers and zombie banks and shadow banks that have financed it, and maybe even zombie states that are ultimately going to have meaningful liquidity problems. Ultimately, the PBOC is going to have to kind of bail this whole thing out. But what are the implications of that? You have currency flight as it is. You have collapsing foreign direct investment in China. So I just think China is faced with a whole array of issues that is going to be hard for them to come up with the right policy mix to work their way out of. I think it's going to take a long time.
Yeah, I mean, and we even point out in the document in March of 2021, they were building 1.71 billion square meters per year. October 2023, we're down to 699 million.
Yeah,
so
you're down by 2/3.
Right.
I mean, it's extraordinary.
And we had the news about Evergrande liquidating just yesterday, which is real time.
Yeah.
Then, of course, Japan and India have been kind of the two outliers in terms of performance. Japanese manufacturing seems to have been increasing. I think the Central Bank of Japan's done a good job at containing inflation relatively. Yeah. I mean, and then India we saw grow at 7.3% GDP year over year, and then and they've gotten a lot of the friendshoring and nearshoring as people have kind of moved from China.
No doubt about it. India is the winner, right? When you hear Apple talk about where they're going to migrate manufacturing, where they're going to migrate a lot of development, it's from China to India. So India really has been the standout winner this year. And then just Japan had these just incredibly cheap stocks that generate huge cash flow. And then when you've got the ever weakening yen, they do very, very well from an exports point of view. So Japan and India, as we point out, really stand out as kind of the global winners in 2023, and I don't see what really changes that.
Let's end on our portfolio analysis section, which we kind of highlighted a blog that you wrote earlier this year, which is really 10 variant views for 2024. Mm-hmm. Maybe we don't have to get into all of them particularly, but what are some of the big standout ones you'd say and ones to look for out these 10?
Well, we make the argument that the equities will go sideways. We don't see the equity markets going higher despite the kind of melt up that is happening in real time. We see inflation reemerging at some point in 2024 as we get through the cyclical drawdown in inflation. We're starting to see the building of some of the more secular inflation drivers or some of the manifestations of secular drivers, one of them being shipping rates starting to move up. Oil prices are starting to move up again. And so we only see the Fed cutting at most 3 times this year versus the market expecting 7 cuts this year. So all of so much of those top 10 surprises are really driven by our view that we have these secular inflation pressures that maybe are taking a backseat right now as there's a disinflationary impulse, but I don't think they're going away. And the surprises really encompass that view that secular inflation is here. It's a new phenomenon. Relatively, well, we're in a new world, right? After decades of falling inflation, we are going to see constant inflation volatility pressures.
Awesome. Well, thanks for your time today, Tim. Right now we just unveiled two of the big parts of the document, which is leading indicators and our portfolio analysis on 10 variant views. Please reach out to WealthVest, if you're interested in this content and if you'd like Tim to come and speak to your branch, or just even hop on a call and we can walk through this, but also some of our other, our strategies and presentations that we have within our institutional brand. So for everyone who's listened today, thanks for your time, and we're out.
Awesome. Thank you, Drew.